Hi there, traders. This is Frank speaking to you on Wednesday, January 23rd, 2008. How are you all doing? Hope you're off to a great start with the new year and your trading. Feels like it's been a while since we last talked. It's been about a week and a half, maybe a bit more. Apologize for any perceived lags in the information flow here. What can I say? Sometimes life just gets in the way. Get busy with other things. I found that even though these presentations are only about 60 minutes long, realistically it's taking me upwards of 4 times that amount to put it all together, to get the chart examples and to cut and paste and put the presentations together and record them and stuff. So I just have to ask your patience because it's just, unfortunately, 4 hours is very difficult for me to scrape together during my average week here. I trade every night for about 6 hours into the wee early morning hours where I live, and then I get up early and I help take care of kids, running them back and forth to school and activities and things like that. So 4 hours is very difficult to find, but I try. Hopefully it's good enough, but please bear with me, and we'll keep these things up on a weekly basis anyway. Last couple of times out, we've looked at some pretty good trade examples, I think. We had a nice 470 pip run on the euro-yen pair a couple weeks ago. That was a good example. And then we had a 160 pip trading example on the pound Aussie last time out. This week I'm going to switch gears back into this kind of learning supplement mode we talk about from time to time. There's a principle that we really need to delve into that we probably haven't talked about enough. It's very important to consider in your trading. I feel like we've been spending so much time talking about Fibonacci that we've kind of gotten away from some of the other core trading tools. And just as a little hint as to what we're going to be dealing with here, Peter Bain's course is called the Pivot Trading System, and the last few times out we've really not even been looking at pivots. And pivots are very important. Let's not forget about them. The reason why I've tended to do one or the other, typically, is that sometimes it can be a little bit a little bit cumbersome or you know, inducing a little bit too much clutter on your charts to have both Fibonacci's and pivots. But we're going to kind of ignore Fibonacci this week for a change, and we're going to talk a little bit more about pivots and how they relate to some of the other trading concepts that we've been looking at so far. So I hope you enjoy this lesson, and let's see what's in store. Okay, so this week's topic, maps and pivots. Maps and pivots. So for maybe some of you newer subscribers, if you're just jumping into the chart of the week example, what the heck am I talking about? MAPS, of course, is the acronym that we've come up with for the entry signal system that we use in this course. MAPS standing for MACD Parabolic Entry System. Maps and pivots. So we're talking about how to use that entry signal system in conjunction with standard daily pivots on your chart, how these two tools work together, because they go together like hand and glove, or at least sometimes they do. And what we're going to talk about here is just that interaction or interrelationship between these two trading concepts and how you can use them to your advantage. First, what I'd like to do is just talk about some simple rules, how to read the MAPS entry signal system in conjunction with pivots. And these are very dead simple rules. And the basic principle being, of course, that anytime you have a conjunction of a map entry signal occurring with price being rejected on a pivot, and by rejected I mean, let's say price is coming down, it wants to, based on the preceding trend, it wants to go through a support pivot, but instead of going through, it finds support on the support pivot and then bounces off in the other direction. And conversely, with a rising market finding resistance on an R pivot above the central pivot. So what we mean here then, of course, is what we want to find is one of those overbought reversal signals on a resistance pivot. And I mean, this is just a generic rule. Sometimes you need to bend the rules or even break them. Can the central pivot be a resistance pivot? Sure it can. Sometimes price can rally up to the central pivot, and even though that's not an R level, it still provides resistance and then price drops. That can happen. But generically, if you have A sell map signal on an R pivot, and I mean by that, I mean anything above R1 as a generic rule. R1, M3, R2, M4, R3, M5, anywhere in that range. If it happens right on the pivot, that's a powerful signal. And ditto for one of the oversold reversal buy signals with maps when price is finding support on any of the pivots from S1 down. Now, as powerful as the map signal can be, you can determine for yourself easily that it's not, you can't trade, we come back to this concept over and over again, you can't trade a single time frame, folks. Map signals are great, but if you just try to do those or act on those just strictly on the 3-minute chart, I guarantee you're going to lose your account over time. You just can't do it. It's a powerful signal, but you have to pick and choose them. You have to validate the map signal with complementary readings on the 15-minute and 60-minute chart as a minimum. And by that I mean not necessarily overbought signals lining up on all indicators on all time frames all at once. I mean, they do occur from time to time, and when they do, you need to jump on those because those are a gimme, right? Give me a good trade. There's one for you. But what we're just basically saying here is complementary readings. So if you're looking for a sell, you should have something on your 60-minute chart that says overbought, or at least trending down. You don't want to take a buy signal when the trend is still clearly down on your 50-minute chart, your 60-minute chart, etc. And just basically ensure that there are no strongly contrarian trend signals on all of those intraday time frames. So that's just basically what all you need to do to find a good potential map entry signal lining up with a pivot. Just some simple rules. And so those are fairly broadly stated, but hopefully they're self-explanatory. All right, so what I'd like to do here is just present just some ideas. This is not a hard and fast system that you necessarily have to run out there and work with. And anytime we put these ideas out, you really need to try them out in your demo account and see if they work for you, because no matter how good something sounds on paper, it may or may not work for you, and that's the important thing. So if you find this idea interesting, please don't use real money until you're comfortable with it. But having said all that, caveats, what I'd like to do is just sort of present a simple approach for using the map signal in conjunction with pivots. So the first thing we want to do, of course, is identify one of those reversal triggers, that confluence of events on multiple indicators on the 3-minute chart. That's our actual signal. So when we see one of those overbought sell signals occurring on an R pivot, we want to be thinking short, right? R for resistance, overbought, meaning that we want to think about a possible short, and those two go together like that. And so the flip side of that is an oversold map signal on an S pivot, anything measurably below the central pivot. We want to be thinking long. And this ties into Peter's concept. We recall that graphic that he's presented in those generic buy and sell zones in relation to the central pivot. Hopefully that's fairly self-explanatory. So it's just, what all that means is just positioning the signals in relation to the pivots. But before you look at one of the map signals, you want to have done a little bit of multiple time frame analysis and already have an idea in your mind as to which way you want to be thinking, long or short, right? So pre-validate the map signal. So in other words, I've looked at my charts, my intraday charts, and I've read the setup on at least the 15 and 60-minute charts, and preferably more. And want to make sure that the conditions are in agreement with or complementary to the map signal. So again, you don't want to be thinking long on the 3-minute chart if the 15-minute chart is severely overbought. But when you've got that concurrence of signals lining up, then you enter the trade and set the stop as per the past examples we've seen of the map entry signal system. So when you've got all the indicators lining up the right way, and then you get your parabolic reversal, then you put your stop on or slightly above or below the parabolic dot, and that's where you get in. And then just in terms of where do you get out, if you're this is like an intraday trading approach, of course. This is not position trading or swing trading. This is intraday trading. But what you want to do is use those pivots to help you figure out where you want to get out. And when I do this, which is quite often, when I don't have a longer time frame kind of trade to think about, what I'll typically do for the pairs I trade, which are primarily the cable cross pairs, I'll be thinking to myself, generically, I would expect 100 pips or better. So what selection of pivots gives me the target that I want to work with? And that'll almost always be at least the equivalent of one full pivot width, i.e. from R1 down to central pivot, from S2 up to S1, something like that. And typically longer, or larger or wider. I would often go for 1.5 pivots, sometimes 2 pivots if the setup is good enough. So, nobody's going to tell us where price exactly is going to come down to. We just have to use those to make an educated guess as to how far price is going to go in our favor before we want to take profit. And you can certainly use a scaling out approach. Lots of people like this approach. I don't use it myself, but I know a lot of people do. Take half your profit at a certain level and another half at a more aggressive level, or even in thirds or quarters, however you want to slice and dice it. But typically, I'll typically aim for at least one pivot. So if I'm on R1, I'll aim for central pivot or what have you, and often more than that. And on the cable crosses, that's easily 100 pips or more per trade per session. Okay, so that's just a very simple, bare bones kind of trading strategy. It's up to you to kind of take these ideas and see how they apply on your charts. But hopefully with the chart examples we look at here, it becomes a bit clearer. So to just set up the examples we're going to look at, I have 5 sample charts, all extracted from the European session of January 22nd. We're going to look at 3-minute charts with map triggers on pivots. And what we're going to do here is look at 5 different cable crosses. And these are my favorite pairs to trade because they have the highest daily range. They tend to have fairly wide pivots. They offer up really great profit potential. Of course, you have to risk a bit more to get your hands on it, but to me it's worth it. The example we're going to look at for pound USD, price moved from S1 up to R2. And I'm not suggesting this was the extent, the likely extent of the profit that you would be targeting for. This is just the magnitude of the run, right? So there's nothing to tell us that R2 was the magic level to get out at. But price was contained between these two pivots. So the maximum theoretical potential on the trade on this day was 288 pips. Okay, we're going to look at pound Swiss, which moved on this day from R1 up to S1 and offered up 147 pips potential. Pound yen, M2 up to M4. That's 2 full pivot width equivalent, right? If we're not going from clear R1, S1 levels, we can consider M1 up to M2 the equivalent to 1 pivot width. 436 pips theoretical trading potential. Pound Aussie was contained between R1 and the central pip, a run down that offered up 304 pips, and then the pound loonie pair put in a really nice run from M5, which is the half pivot above R2, down to S1, a range of 206 pips. So the total theoretical potential of these 5 pairs in the European session on this night was 1,381 pips. Again, I'm not suggesting that I or you or anybody was necessarily likely to extract that amount. That's an unrealistic assumption because it assumes that we have a crystal ball and we can determine exactly where price is going to go, which is sometimes difficult. But for the sake of argument, let's just say that you were able to bag, let's just say 3 out of the 5 trades. Okay, we have 5 trades coughing up 1,400 pips. That's what? That's about 280 pips. 5, yeah, 280 pips each average. So let's say 3 of those runs, and let's say you bagged half the potential. Or let's just say 900 pips total potential, and you grabbed half of it, half the available potential on 3 out of 5 of these trades. That's still over 400 pips. That's not bad on one session's worth of work. I'm sure we would all be very happy if we could consistently grab 400 pips on a single night once or twice a week. That's phenomenal if we can do that. So I'm just putting these numbers up just to give you an idea of the scope. Not to suggest you would necessarily grab that all, but if you're doing half that amount on half the trades, you're still going to end up, laughing all the way to the bank. So just to give you an idea, these tools work really well together. So now what I'm going to do is I'm going to look at a couple of chart examples to show you how these two concepts work together. But first, I'm going to just digress briefly by way of just a mini tutorial on a new feature with Pro Realtime IT Finance that I need to explain before we look at the charts. Okay, so we're going to just have a brief digression here, brief diversion. Call it a mini tutorial on a new feature. And I don't want to go into it in any great depth. I know a lot of you are not Pro Realtime users. Probably most of you are not. Some MetaTrader junkies, AccuCharts users, and so forth. So I don't want anybody to feel like hard set upon here to try out something new. I'm just going to explain this new feature so you know what you're looking at. Of course, the thing that jumps off the page here is these colors that you've probably never seen. Well, you wouldn't have ever seen before. Pro Realtime is just in the process of finalizing a new beta site for a relaunch of their charting platform, which is going to include a number of upgrades and cool new features. And I've been asked to participate in a small-scale user feedback group here. So not even the regular paying subscribers to Pro Realtime will have seen this yet, at least as far as I know. You guys are the first. You're seeing it before anybody, even Pro Realtime users, if you're not one. I don't know if I'm supposed to be doing that, but I can't see the harm. I'm not going to explain what all the new features are, but one that I've decided just to go ahead and use because I like it so much is this color feature. It's called Dynamic Color Zones. Okay, and that's a lot of fancy geek speak for the concept of shading in portions of your chart where price and or your indicators is traveling above and or below a specific benchmark or threshold which you define. These color zones are totally flexible and user definable just the same way that the Pro Realtime chart alarms are, which I've shown you in a previous example. You can set it up however you want. Any combination of trending variables, I suppose you'd call it, you can color code it. So what we have here, you can see this is 100 EMA, and when price is below the 100 EMA, the gap between the moving average and price is shaded in red, or this kind of rosé color, and vice versa. When it's above, generically bullish, it shades in green, right? And then you can see the same thing for each of the indicators. When the MACD1, the slow MACD, punches above the 100 EMA, it shades in green and remains there until it crosses back down and through, in which time it turns to this kind of rosé color. So that's how I've got it set up on my charts. Now, this is not an indicator. It's not a signal. It's nothing more than just an interesting chart format technique. I happen to like this because I find myself, I'm a very visual person. When I'm looking at a chart, I don't want to have to spend any more time thinking about it or eyeballing it than is absolutely necessary. I want the chart to tell me what to do with clear signals. And this just helps make overbought, oversold dips that much clearer, right? When I'm looking at this here, let's take, for example, here was a good classic textbook map long entry signal right here. We're looking at the pound loonie pair for the 23rd in real time here. So we had oversold, 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 and then we had the parabolic reversal happen here. It's really nice when we're looking for these dips and rallies, we don't have to think about what we're seeing so much. It's just everything is painting in red across the board. It stands out that much more visually. So that's all it is. It's just, coloring in bearish for when price is below, coloring in bullish for when price is above, and same thing with the indicators. And you can adjust this however you want. Let's just say, for example, that I don't want the relevant threshold to be the moving average. Let's say I just want it to be the pivot. So I change it like that. When price is below the central pivot, it shades in red. And I can just change it however I want, like that. If price is above the S2 pivot, paint in green and so forth. I just happen to choose the 100 EMA and it works like that. And similarly, you can change it up however you want. Let's just say you don't use indicator overlays. Let's say for MACD, instead of the moving average, I want to use the waterline. Okay. Anytime MACD punches above the waterline, it shades in green. Anytime it punches through, heading south, it paints in red. Same idea. I just happen to like using the moving average. It works for me. And just one more example here. Let's say if instead of the moving average for SMI, you want it to paint in above or below the oops, I didn't do that quite correctly. Sorry. Color zone 1, stochastic momentum index above 100, horizontal line. There we go. Okay, I finally got it. So now you can see what's happening is SMI is painting in above the plus 40 line, and I can change that also to doing it red below the minus 40 line. Okay, but again, I just have it consistently in relation to the moving average. And I think I've just messed this up a little bit. No, that's fine. Okay, so that's just a quick digression on what these color zones are. I know if I didn't explain it, it might cause you to be sitting there scratching your head a little bit. Just a handy new formatting feature, and one that will be announced formally with the soon-to-be relaunched Pro Real-Time chart. So that's it for that. Now let's move on to the actual pivot examples I wanted to talk to you about. Okay, on to our static chart examples here. And this is a case where a picture tells 1,000 words, right? You've heard me bantering on about rules and trading strategies and stuff. This kind of just really lays it out crystal clear and also demonstrates this color coding concept really well, I think. So remember that rule. We say if we're below the central pivot and price is touching on, i.e. finding support on an S pivot, and that's occurring in conjunction with a MAP long entry signal, then what do? We think long. Here's the MAP long entry signal, right? RSI, a little bit jagged, but it's close enough to oversold. It's just bouncing off its 30 line. SMI, clear bullish crossover, ditto, and support on S1, and then we have the parabolic reversal. By the way, just as a quick aside here, something else I have to mention, if you're using a different charting platform, as of today, the daily pivots feature on Pro Real-Time is calculated based on the GMT clock, right? Midnight GMT to midnight GMT. It is not calculated based on midnight Eastern Standard Time, the New York time frame. And my contact at Pro Real-Time has advised me that that is a feature upgrade that they're working on and will release in the near future, is to have a user-definable pivot time frame. So, if you prefer midnight Eastern Standard Time, you'll be able to do that. But for now, it defaults to GMT. And this has been a kind of a question, an open question, some cause of debate, I guess. I've been working with the EST pivots now long enough. I have no doubt whatsoever these pivots are perfectly fine. They work just great. There's no problem at all working with GMT instead of Eastern Standard Time. And kind of logically, that's always made sense to me. I don't know, maybe I'm wrong, but why would traders in London and New York care about midnight New York time? That's never made sense to me. Why would they not calibrate to a 24-hour clock relative to their own time frame? And this kind of proves it. These 5 charts that I'm going to show you prove that the GMT pivots do definitely have traction. They provide meaningful support and resistance. And if you're ever in doubt, just look at the chart examples. Can you find clear instances of price finding support or resistance on the pivots? This should happen several times a day. If it doesn't, then your pivots are probably no good. If it does, if it explains what's going on in your chart, that's reason enough to work with them, in my opinion. Anyway, price on cable, pound USD on this session, January 22nd, European session. And look at the timestamp here, London Open, 3 a.m., right there. We had a swing right at the London Open. Peter talks about this all the time. Swing points at session opens and closes. It's not always a guaranteed thing, but when it happens, it's magical. So we got the MAP long entry signal on S1, and price ended up running all the way to R2 within its daily range on this particular day. And I'm not showing what happened afterwards, but this relative to the pivots is the extent of the run here. And so again, how much are you going to go for? Is there any magical clue that says this thing is going to go to R2 as opposed to R1? No, there isn't. The only way you could see this thing all the way through is just watching it in real time. For most of us, that's not a possibility. So I guess this comes down to kind of a not terribly sophisticated trading decision, but one which might work is ask yourself basically how much do you need on the trade to make your risk-reward calculation favorable. You can see that just by eyeballing this thing from S1 at 93.44 up to the central pivot at 94.59, that's 115 pips. So that right there is a nice little run, and on the chart it doesn't even look like much, but it's 115 pips. So if you want to play it safe, you could just take a one pivot trading strategy and say, get me in here and then get me out at the next pivot if you want to limit out. And that's 115 pips on the table, and looks to me like not very much time at all, about an hour. This particular night it was very volatile. Cable ran up 100 pips in less than an hour. And that was perfectly fine. And you can see if you wanted to target R1 even, a two pivot trade, that was good too. Let's just track price action here. We had the MAP long entry signal here, S1. Price had a little bit of congestion at the central pivot, but we can see from our trend following indicators, the slow MACD, there was no reason to believe this thing was turning around yet. If you drew a vertical line right here, this thing was still, pardon the expression, hell and gone bullish. It was not turning the corner here at all. The fast indicators were, but we knew these were fake out signals, right? We remember this concept, the twin MACD panel concept from the course content. When your slow MACD is trending up with angle and separation and your fast signals turn the other direction, these are fake outs. So price went further. No surprise. Look what it did. It just touched literally to the pip on R1. Little bit of congestion, got knocked sideways, tried to move up, not much momentum there, sort of thrashed around up and down, and then finally there was one final push, and it took us right to R2. Right? You can see these pivots are explaining what's going on here very well. Resistance to the pip. Resistance to the pip. Support to the pip. These pivots are working. So this was a run worth, what did we say, 288 pips? We wouldn't necessarily have had reason to expect this was going to go 3 pivots wide. We wouldn't generically default to that kind of a target. That's very aggressive in my opinion. But you could certainly have targeted one pivot move, and using a scaling out strategy, you could have maybe taken half your profit on the central pivot and the other half right here on R1, or maybe divided into 3. One third, let the other third ride if you feel comfortable in doing so, and trail the stop to break even so that regardless of whatever happens, you're not going to lose on this last position. Any of those strategies would have been just fine. But again, this just shows how when you have this conjunction of the MAP entry signal occurring together with the pivot, support or resistance, it's a really good thing. Okay, here's our next chart example, pound Swiss. I can't remember if I've mentioned this already. I'm focusing on the cable crosses because they tend to offer the widest daily range and the best volatility. Occasionally, I'll look at a couple of exotic cross pairs, the pound Sweden, Swedish krona, GBP SEK, and the pound Norwegian krona, GBP NOK, and occasionally the pound Kiwi. These pairs as well offer up just amazing average daily range. And I'm just going to pull up no, actually I won't. I was going to pull up a spreadsheet, but it's too hard to find right now. But as an example, Pound Norway for the week of January 7th. Now you have to keep in mind, in terms of nominal pip values, it looks a little bit exaggerated because if you do the counting, it looks like 1,000 pips a day, which is not actually accurate because kroner is I believe about 5 to 1 relative to the U.S. dollar. But when you do the conversion, it works out to easily over 400 pips a day on a USD equivalent basis for pound Norway. So you might want to just check that out if you're interested to see if your broker offers that pair. Sometimes these exotics have just hellacious margin and spread requirements, so it might not be attractive in that sense. But I know for a fact there's a broker in Singapore I work with actually who offers these pairs for trading, and the margin requirements and spreads are not half bad. So, but that's only if needs be. Usually, we don't want to look at more pairs than we have to. 3 or 4 is certainly enough to get the job done when you're working with cable crosses. As to how this works with the other pairs, the more modest, lower daily range pairs like dollar, yen, euro, USD, and so forth, I don't really know because I myself don't work with those, but I know this works very well on the cable crosses. I don't see any reason why it wouldn't, but anyway. So again, let the picture do the talking. And this demonstrates this color coding concept really well. Price oversold relative to the 100 EMA. Oversold, 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 oversold. Collectively, that gives us the MAP long entry signal. Where is it happening? We've got railroad tracks or tweezers, whatever you want to call it, on S1, and then we've got the reversal signal. Which direction are you thinking? Are you thinking short here? I sure hope not. So this was a real quick in and out trade here. If we went long on S1, it was just a quick run up to R1, and that was a difference of 1463 and 1610. That is about 150 pips, if I did my math correctly. I think I did. 1560. Yeah, 150 pips straight up. Now the interesting thing is we also had a sell signal right here, but I don't know that our higher level validation was suggesting that was appropriate to go short at that point. This was the safest run for the night, and it was over inside of an hour for 150 pips. So 2 for 2 on our 5 cable crosses as far as the MAP entry signal with the pivots. And our good friend Mr. Pound Yen, the mighty Pound Yen cross pair, the beast with the big daily range. This was actually a counter trend move, and you know what's really interesting about this? Here we had a big, 400 something pip counter trend run, and it was happening during the London session. Essentially the day before, we had what happened on January 22nd, Tuesday, during New York hours. We had, as far as a news event, we had a quote-unquote surprise 75-point rate cut. A surprise announcement from the Fed. They slashed rates 75 points, which was really no surprise. That has been predicted by a number of people. Elliott Wave International, their news service, they predicted that was going to happen about 3 weeks ago. They said there was going to be a surprise basis rate cut before the next meeting, and that's exactly what happened. And why did it happen? Well, I hope you've still been following the Dow because as predicted as far back as October last year, we've been talking about this. The Dow was set for a big plunge, and that's exactly what it's done. It's just blown by all the relevant highs and lows of 2007 is into fresh new bearish territory. And so in my opinion, at least rather pathetically, they've responded to this problem created by cheap credit by doing what? Making credit cheaper. It's just fighting fire with fire, and it's not going to work. But that's what the Fed does. They sense an emergency situation. They want to make it look like they're doing something. So what do? They slash rates. Cheap credit is what got the stock market into trouble to begin with. Why are they making it even cheaper? It's not going to fix anything. But anyway, that's what happened during New York hours. And so the response from the stock market was to initially tumble and then close lower, but to close off its lows for Tuesday, right? That's what happened. We had what amounted to a big, huge hammer on the daily chart for the Dow for the 22nd. And so there was some buying There was some buying in response to the rate cut. But so the market went higher. But so as the Dow goes higher, the carry trades go higher, and vice versa. We've talked about this relationship before, but we didn't even have to wait for the Dow to open on Tuesday. This was the European session. It's almost like somebody knew something was going to happen, and they sent the carry trades on a rocket trip upwards in the counter trend direction. Very interesting, isn't it? Kind of makes you wonder. Anyway, the move here for pound yen, the safe move anyway, was M2, which is the gray line I've got shaded in here, and M4. So that's the equivalent of a 2 pivot wide move, right? M2 to M3, M3 to M4. It's sort of, conceptually at least, is the same thing as going from S1 to central pivot to R1. And so we're below the central pivot on a support pivot. We had a MAP long entry signal, and price thereafter moved up. And I'm not showing the higher level time frames. I'm just focusing on the signals in conjunction with the pivots. But generically, the conditions on both the 15 and 60-minute charts were oversold. So that was compatible with, i.e., gave us permission to jump on this long entry signal and ride it on up. So we're 3 for 5, or 3 for 3, I should say, 3 out of 5 pairs with the MAP signal working in conjunction with daily pivots. Here's pound Aussie now, another cable cross that tends to put in just beautiful, big, wide average daily range moves. And this shows you, though, that you can't necessarily take the mindset that as goes one pair, so go the others. We've seen so far that pound, USD, Swiss, and yen all essentially traveled in the upwards direction. That was the big move for the night. But in this night, the big move actually was not up, it was down. Because remember, in this pair, cable is moving in conjunction with Aussie. Aussie might be doing something completely different from those other cross rates. So that might have some bearing on this pair. But you can't assume that if pound USD is going up that they're all going to go up. It might be a different relationship. And that's what happened here. The move for pound Aussie was down. A really good one pivot move. And this is an example of where using a little bit of just your own subjective judgment is necessary, because we had an extremely wide pivot ranging day here. This is R1 down to central pivot, a difference from 27.93 down to 24.89. That's like 2,800 down to 2,500. That's 300 pips in one pivot span. Now, do you really need to target more than 300 pips on just a simple pivot trade intraday basis? Probably not. As a matter of fact, there might have even been good reason to just conservatively target a half pivot range. Go from R1 when you had this MAP short entry signal. Again, price coming up to resistance, meeting resistance, being rejected, a short signal here, parabolic reversal, etc., etc. And a validation provided by overbought signals on the 15-minute and 60-minute charts. From 27.93 down to halfway through this range here, that was 150 pips. Is that good enough? Well, it is for me. I'd be happy with a half pivot trade right here. Conservatively, I might have tried for that, or maybe put in 2 lots, scale out, take half my profit here, and then see if I could maybe trail my stop if I was in the market still on my still open position and let it ride down to central pivot. Got to remember, these pivots, they act like gravity points for price action on an intraday basis. Sure, we've got other stuff going on higher levels. We've got high-level Fibonacci's and so on and so forth. But on a time frame like the 4-hour or daily, they often take their time getting to where they need to go. And in the meantime, they have to deal with these intraday pivots. So these are gravity points. And if the price is going to be rejected at R1, it's either going to find some traction at M3 or it's going to go on to the central pivot or further. But in this case, the relevant move was down here. So, a one pivot move right on this pair alone was worth 300 pips. Would you have targeted that much? Depends how aggressive you want it to be. I might have, if I thought the move was compelling and my higher level top-down analysis said the trend was down. I might have, or I might have just gone for a half pivot from R1 to M3. Either way, a nice A nice move, again, predicated by a MAP signal on a pivot. One last pair to look at now, pound loonie. All right, now the noise distraction in the background is my toddler-age daughter watching a little TV. That's Sesame Street you may or may not be hearing. Sorry about that. Hope it's not too onerous. Anyway, this is our last pair, pound loonie, pound CAD. And this was a bit messier. But it's an interesting example because of something you have to be aware of. And that is selecting your entry signals wisely. On this particular night, or actually closer into the New York Open, or the North American Open, I should say, because it trades in Canada as well, I would presume, is we had a reversal signal occurring at 9 a.m. precisely on M5. M5 is way up in sell zone, right, as per Peter's paradigm. This is above R2 even, so this is really sell zone. And we had, this is kind of a knee pattern on the slow MACD, which is fine because in the background we had a preliminary crossover. Now, take note of the times. We're going to actually look at the higher time frames. I'm going to talk about the importance of validating these signals because you might be looking here at this chart and saying, well, gee, Frank, 6:09 a.m., we had what looked like a really good MAP short signal to me. Why wouldn't you have taken that? Well, this highlights the dangers of trading a single time frame approach. Yes, this was a good signal by the looks of it, but the market wasn't ready to turn over in earnest, and this example will show it. So we had a run down from M5, and this chart doesn't show it just because I haven't taken it far enough out, but we actually ended up going down as far as S1, which was a nice long run. I'm going to show you now the 15-minute and 60-minute charts to demonstrate how to validate these signals. All right, so on the last chart, the 3-minute chart, we saw that we had a signal coming in around a little after 6 a.m. So I've got two vertical lines here, one corresponding to 6 a.m. and one corresponding to 9 a.m. on this 15-minute chart. So when you saw that signal in the 3-minute chart, the first thing you would want to have done is just go back and look at your 15 and 60-minute charts to see if you were ready, to go short. Now, from the bottom up, we had, yes, RSI was overbought. SMI was crossing bearish. Fast MACD actually still had a bit of angle and separation, but it looked like it might be approaching a topping out here. The histogram was certainly waving lower. But the spoiler was the slow MACD. There's no way in heck you want to trade short against a signal like this. Just pretend that this was the live edge of trading and we didn't have any of this information to the right. This is strong bullish angle and separation on the slow MACD. This really demonstrates the power of this twin MACD concept that we talked about over and over again. And what it does is it conveys the idea that you really do have to have your indicators in alignment on at least 2 time frames, at least, bare minimum, preferably the 60-minute as well. But in this particular case, at 6 a.m., when we saw that first short signal on the 3-minute chart, you would not have wanted to take it because this was just way too bullish. We had to wait until this thing really topped out and flattened out and really was poised for a bearish crossover. You can see what happened in the meantime. After 6 a.m., the fast indicators crossed over, but these were still fake out signals. We didn't want to act on these just yet until the slow MACD was good and ready, right? Because what actually ended up happening is we had a 1, 2, 3, or actually a double top here to end this rally. Price rallied, hit an initial high, the trend was still up, price fell off, came back, retested. It was here, the second entry point, where we would have been safest to go short. So you really have to read and validate these signals on multiple time frames. And let's take a look at the 60-minute to see what it told us. Okay, same idea here. I have drawn these dashed vertical lines corresponding to the hourly bars, which furthermore corresponded with the 2 different 3-minute signals we saw. And again, if you just pretend in each case that that represented the live edge of trading, so there was nothing to the right of this line here. So if you looked at the 15-minute at 6 a.m., you would have seen that the slow MACD was still bullish. So what did the hourly chart tell you? RSI was kind of topping out. SMI still bullish angle and separation here. This was still up. Signal was still up. Lots of space here. Was not technically overbought yet. Fast MACD was still very bullish, and the slow MACD was kind of hard to read, really, just kind of dipsy-doodling on us. But if you looked at just those two time frames, you would have had reason to doubt the safety of that first signal. So what do? If you don't feel safe jumping on that first signal, well, you have to assume that if you're going to get a safe entry point, it's going to come later. So you just sit on your hands and you wait for it. If it comes, you take it. If it doesn't, you don't. It's just that simple. We have to be patient, and we have to maintain control over that itchy trigger finger that we sometimes get. You just have to wait until it's clear to move, clear to act. There's no danger. I would definitely say, based on the 15-minute and 60-minute views, at 6 a.m., there was no way in heck that we should have been thinking it was time to go short yet. But again, on the start of the 9 a.m. candle here, what did we have? Well, the slow MACD was, not giving us a whole heck of a lot of anything. Just a kind of a wibbly-wobbly reading here. But by now, the fast MACD, you can see it sort of hit a peak and was now turning down. Not a super clear signal, not a bearish crossover, but at the very least it was much more conducive to a short entry. It was generically overbought. SMI was clearer. It was coming in for a bearish crossover. You can see it was touching its signal right here. And RSI had already crossed through the 70 line, bounced up again, and was now rejecting that and crossing through its 100-period EMA, which is kind of like a nice trigger line for RSI. So this wasn't a perfectly clear signal like over here. We had a really nice reading on the hourly chart, super clear. Like if you weren't thinking short here, well, I don't know what you would have been doing, but this was much clearer over in this direction. This signal wasn't as clear, but it just demonstrates in real life how we sometimes just have to kind of put everything into a big pot, mix it around, and see what we come up with. As far as our assumptions and readings go, I would say this was much safer as an overbought signal at 9 a.m. than at 6 a.m. And the 15-minute chart definitely bore that out. So just, I didn't do this kind of analysis for the preceding 4 pairs, but just thought I would show you, because there were 2 different entry signals, you could consider how you have to read a multiple time frame approach to validate those signals. I got an email from a gentleman in Singapore, one of the course subscribers named Jensen. Jensen, I hope you're listening to this. He was asking this very question, like, when can I take these map signals in conjunction with the other indicators, other time frames? I hope this example makes it a little bit clearer. Anyway, that's it for the chart examples. Let's move to our recap now. All right, so what did we learn this week? Map entry signals that occur concurrently with price rejection on a daily pivot, and it doesn't matter whether your pivots are Eastern Standard Time or GMT or what have you. Whatever pivots work for you, just go with that. If your pivots are meaningful, price will interact with them. So by price rejection, of course, I mean price was testing a resistance line and was not able to go through it. So the only direction from that perspective is down, and similarly price was trying to penetrate a support pivot but was unable to do so. You get your map entry signals concurrently. It's a very powerful, at least potentially powerful signal. You just have to make sure you're validating stuff with your higher time frames and doing a multiple time frame analysis. So again, the rule is just make sure you're lining these things up the right way. Okay, so by OB I mean overbought on a resistance pivot. Resistance can include the central pivot, and it can even include a support pivot occasionally. But the safest kind of approach conceptually is let price be in that sell zone above the central pivot and line up an overbought map signal with price on a pivot. Similarly, oversold on a support pivot. We didn't do particularly impressive, fancy, sophisticated multiple time frame analysis in these examples. On Pound Loonie, we just looked at 2 other charts, the 15-minute and 60-minute chart. that can be plenty good enough for intraday trading on pivots. You don't necessarily have to have the stars and planets lining up on everywhere from the monthly on down to the 3-minute chart. That's extremely difficult to do. But make sure you're looking at least at 2 higher time frames, because if you're just shooting from the hip on these signals, like I say, you're gonna find yourself on the losing side of 5 straight trades at some point, which is not a very enjoyable experience. Just as a rough rule of thumb, in terms of once you've got that entry signal, a nice tight stop, well timed, you can just simply use a 1 or 2 pivot wide profit target on these wide-ranging pairs like the cable crosses, and like we've seen in these examples, that can be easily good for anywhere from 70 to 100 pips. Those are high probability, relatively low risk trades, in my opinion at least. And you can, depending on how much you are putting on the line in terms of position sizing, that can be good for, that's a pretty nice tidy little income if you do that 2 or 3 times a week even. And on these pairs, if you're looking at 4 or 5 cable crosses, it's not hard to find at least a half dozen of those types of setups a week. Nail 3 of them a week. 300 pips on a 1-lot trade, that's $3,000 a week. Most people could live quite nicely on that. That's all I have for this week, folks. I hope you found this module, this presentation useful. I just wanted to make sure that we weren't losing sight of the very important concept of daily pivots, since we've been talking about Fibonacci so much. So if this is leaving you a little confused, Fibonacci pivots, what do I do? Well, you don't have to use both. You can just use pivots. Daily pivots is fine. You don't have to become a Fibonacci expert. It's actually, in fact, it's actually a simpler way to trade. It's easier because with pivots, you have one set of pivots, and they're the same regardless. You can certainly use weekly or monthly or yearly pivots as well on those higher time frames. But for an intraday trade, you don't need to think about any other pivots than the daily pivots. They're fixed. They don't change. They're not user adjustable unless you change the time frames. Whereas with Fibonacci, you really have to sort out potentially a lot of different setups on different time frames. And they're not quite as fixed or static. They're dependent upon your ability to find swing points and your judgment in selecting which fib level, which extension price is going to go to, which can be a bit trickier. So this is actually a simpler way to trade. It's easier. There's no question. Pivots are powerful. You line up your map entry signal with your pivots, away you go. It's a good thing. That's a bad expression. Anyway, that's all for this week, and thanks for your patience awaiting this module and the next one. We'll try to keep this up more regularly. Good luck, good trading. Talk to you soon.